Hello, I'm the awesome Tutor, and today we're going to be looking at the balance of payments. Okay, so first of all, what is the balance of payments? It is a record of all a country's financial transactions with the rest of the world. It looks at money entering the country and money leaving the country. It looks at inflows and outflows, credits and debits. And the balance of payments consists of three parts. The current account, which is the main one you're tested on, the capital account, and the financial account. So let's take a look at the current account. So the current account of the balance of payments measures the balance of trade in goods and services, net investment incomes, and net transfers. For the balance of trade in goods and services, you're basically looking at X minus M, the value of exports minus the value of imports. Now sometimes the balance of trade is split up into two, the goods and services, the balance of trade in goods, which is visible trade, and the balance of trade in services, which is invisible trade. Visible trade because goods are physical products, they're tangible, you can touch them. Unlike services which are invisible like banking, insurance, consultancy. So with X minus M, if the value of exports is bigger than the value of imports, then you have a trade surplus. If it's the opposite, the value of imports is bigger than the value of exports, then you have a trade deficit. Okay? Exports, remember, are inflows. Okay? Say we have the country here. You're selling something to the rest of the world. So here's your country, you're selling your product. Okay? You're going to receive money from that product from overseas. So in comes the money. So what's in exports are inflows into the country. Imports, on the other hand, other countries are selling you products, so you pay them money overseas. So money exits the country, so imports are outflows. Okay? So, just because you have a trade deficit does not mean you have a current account deficit. And just because you have a trade surplus does not mean you have a current account surplus. Okay? The balance of trade in goods and services is a part of the current account, and mainly it's the largest part of the current account, but there are other parts of the current account as well. And then investment incomes, net transfers. So you could have a trade deficit, but still have an overall current account surplus, because there might be larger inflows in the other components, like net investment incomes or net transfers. So this isn't GCSE, okay? Trade deficit and trade surplus are not the same as current account deficit and surplus. So make sure you don't make that mistake in the exam. There is a distinction. So now let's look at net investment incomes. Net investment incomes looks at incomes, okay? The income earned by domestic citizens who hold assets overseas, or the opposite of that, the income paid to foreign holders of domestic assets. Okay, so we have like profits, dividends, interest, wages, remittances. Okay, so for example, I'm in Bahrain. For those of you who don't know, that's a country next to Saudi Arabia. So that's Bahrain, and this is the UK. That's me in Bahrain. Let's say I have a transnational or multinational company, a company based in the UK, and I earn a share of the profits made by that company in the UK. That means I will receive dividends from that company base from the UK to Bahrain. I'm receiving income from the assets I hold in the UK. Okay, so in the balance of payments in the UK, that will be an outflow. In Bahrain, it'll be recorded as an inflow. Okay? Now, net transfers. Net transfers usually looks at money transfers between governments. It mostly involves stuff like foreign aid payments and stuff like that, or sometimes even grants, like those given to the UK as part of the EU Common Agricultural Policy, although I don't know if that will continue to be the case with Brexit going on. So let's look at the capital account. So the capital account measures transactions in fixed assets. So capital coming in and out of the country. Okay, capital account, capital. It mainly looks at migration though. That is the largest part of this account. So if you immigrate into a country, your assets become part of that country's assets. Okay? So that's reported as an inflow. If you emigrate out, that's an outflow. The capital account is a relatively small part of the balance of payments, so you don't need to know much about it at this level. So we're going to go to the financial account now, which is much more important, especially when you see the link between the financial account and the current account. So the financial account, not the capital account, okay? The name changed a couple years ago, so if you have any old textbooks, be wary of this. So the financial account measures transactions in financial assets, not fixed assets like the capital account. Okay, then so what's the difference then between financial assets and fixed assets? Well, financial assets are basically liquid assets, okay, and include stuff like cash, stocks, bonds, bank deposits, stuff like that. Whereas fixed assets are physical assets, okay, stuff like land, property, commodities, fixed assets. Okay, now the main component of the financial account is FDI, or foreign direct investment, and that's a long-term financial flow. You also have your loans, your foreign exchange reserves, and portfolio investment. Now, portfolio investment, fancy word, right? It's basically investment in securities with the expectation of earning a return. So stuff like buying shares, bonds, stocks, government securities, stuff like that. Okay, and also it measures hot money flows and capital flight, I would presume. So portfolio investment, it's mainly undertaken by speculators. Okay, speculators are these like investors who invest in stocks, bonds, government securities, all over the world internationally, expecting to earn a return on that investment so they can basically make a profit and make money. Foreign exchange reserves, that's your supply of foreign currency. So here in Bahrain, the currency is the Bahraini dinar, the BHD. We have foreign exchange reserves. Most countries usually have as their main currency in their foreign exchange reserve as the dollar. Okay, because that's pretty much almost like an international currency. Okay? So, let's move on. Now, a very important thing you must know about the balance of payments is that it always balances. Okay? The balance of payments must always balance. Now, what does that mean? I'm going to explain it. So, let's say we have two countries. Country A and country B. Country A has domestic production, 100 million. And domestic consumption, investment, and government spending, 150 million. So it's consuming more than it's actually earning in income from the output it produces. by 50 million. That's the difference. But it has to get that 50 million from somewhere, right? Let's look at country B. Domestic production, 150 million. Domestic consumption, investment, government spending, 100 million. So it's earning more than it's actually consuming by 50 million. So where does that extra 50 million go? It goes to country A. So if one country has a deficit, country A, here minus 50 million, another country around the world must have a surplus. In this case, country B, with positive 50 million. So that 50 million, basically what I'm saying is, obviously this is a huge simplification of a complex economic concept. Okay? But it's just so it's easier for you to understand. Basically, I'm assuming that the 50 million, that the extra 50 million that the country B produces gets exported to country A. So that's a surplus here. Alright? And the 100 million produced that's left gets consumed. With country A, it's producing only 100 million, but it's consuming 150 million. So it's got to get that 50 million from somewhere. In this case, it gets it imported from country B. So it has a deficit of minus 50 million. Okay? Stay with me now. Let's break it down further. Okay. So country A needs that 50 million from somewhere. Okay? It has a current account deficit. And because the balance of payments must always balance, there must be a surplus somewhere else in the balance of payments. So this is going to be either the capital account or the financial account, or both. So you have an outflow in the current account, you need an inflow from somewhere else to fund that current account deficit, to fund that outflow. Okay? So there's going to be a surplus in the other parts of the balance of payments. Okay? So how are you going to fund the deficit? Because you need that 50 million from somewhere. Okay? So you need to fund that deficit. Option 1. You print money. But that has all sorts of problems because it will lead to inflation, if not hyperinflation. So we don't like that. Number 2, attract foreign direct investment. Number 3, you can borrow money in the form of international loans, but that also has some long-term problems. It will increase indebtedness within your country because of interest payments. So we're wary about that one. Number 4, you can use your reserves, your gold reserves or your foreign currency reserves. Okay? But those are going to run out. So that's only a short-term solution. So we don't like that one. Okay. So country B has that extra 50 million. It also has options on what it can do with that 50 million. Okay? It can either invest it abroad, it can save it in its reserves, which will be bad for country A because it needs that 50 million from somewhere, and B has it. Okay, this is the case with Germany, which has a huge current account surplus, but it likes to save it, so it's bad for the other European countries. So B has that extra 50 million to spare. Now, if we look at FDI and loans, that can come from country B and go to country A. Okay? So, country B can do what it wants with that money. As I said, it can save it, or it can loan it out, and it can invest abroad. Alright? Not just country A, can do that with other countries, but let's just assume all that 50 million goes to country A. Okay? in the form of FDI or loans. Now let's get into the real nitty-gritty of it. Okay, so remember, FDI and loans, where are they recorded in the balance of payments? They're recorded in the financial account. That's a weird L. Financial account. Okay, so country A has a current account deficit of 50 million. Country B has a current account surplus of 50 million. Okay, so as we said, A needs that 50 million from somewhere. B is going to give A that 50 million in the form of FDI and loans. So country A has a current account deficit of 50 million. But now, because of country B, because the FDI and loans are coming from country B and they're an inflow into country A in the financial account, we have a financial account surplus for country A. Okay, let's ignore the capital account to make things simpler. So for the current account, minus 50 million, financial account, positive 50 million. Overall, add them together, you get 0 on the balance of payments overall. It balances, because the balance of payments always balances, okay? Obviously, of course, it's very difficult to measure international transactions, so we always incorporate something called a net errors and omissions item, which makes sure that on paper the balance of payments actually balances, okay? So you can't have a balance of payment deficit. You can't have a balance of payment surplus. That's wrong. This isn't GCSE anymore, okay? The balance of payments always balances. You can have individual components of the balance of payments in terms of deficits and surpluses, but not the balance of payments as a whole. Overall, it balances. Okay? So next time we're going to look at specifically current account deficits and surpluses, the causes and consequences of that, using specific examples to get those application marks. Okay? So this has been the Awesome Tutor. Bye!